Good morning, everyone. Hope you're having a fantastic Thursday. I am Gerald Green here with one of our other advisors, Taylor Steward, and we have a special guest, a senior portfolio manager, Mr. Jeremy Bryan. Taylor, why don't you go ahead and introduce our special guest here?
Yeah, so Jeremy Bryan is the senior portfolio manager here at Gradient Investments. So Jeremy, if you will, just start kind of by telling us a little bit about yourself and what the market review and outlook is here with Gradient Investments.
Yeah, certainly. Thanks for having me, guys. I appreciate it. So I am, as they said, I am Jeremy Bryan. I'm the senior portfolio manager here at Gradient. So what that just means, and the slide just came up, so it's great, is I manage the investment team here at Gradient. And so what we do is that we actually, if you think about the plan and the process, the team at Mattson is putting together the plans and understanding what your specific needs are. And then they give those plans to us and the thought process there. And we design portfolios and give you solutions that we put to work in the markets. So when you're talking to me, when you're talking to my team, you're really talking to the people who are actually investing your money. And so this is the crew here, Mike Binger, senior or president actually of Gradient Investments, used to be in my chair. So that's why I almost called him senior portfolio manager. And then me, and then we obviously have Marianne Montaigne and Keith Gangle as portfolio managers as well. And then Tyler Ellegard and Jordan Thorpe as our investment analyst team. So quality team here, been around a long time. We know the markets, we've seen cycles. So, you can tell by my gray hair that I've been around for about 20 years. And certainly the other members of the portfolio management and president team have been over 30 years in the market. So seen a lot, done a lot. And so happy to answer any questions we have. But today's focus is going to be much more on the lines of just giving you a broad scope of what's happening in the markets and kind of what we see going forward. So you wouldn't mind shooting to the next slide? Thank you. So, I always like to start with this slide because it really shows the ride we've been on lately has been, I would say, pretty volatile. Very big swings, both up and down, and very quick. This is a 2-year chart, basically, and usually you don't see this level of aggressiveness of up and down in the volatility of the stock market. This is the S&P 500 right here. And so you saw in September of 2018 to December, we had almost a 20% drop in the markets. And subsequently, we rallied aggressively up until we started to feel the effects of COVID and the issues that happened there in February of 2020 to then we had a very significant drop of over 30%. Up until what happened is, during that time, in my case, it happened very fast. And we also recovered very fast, which if you would have asked me in March where we would have been by year end, I would have not suggested that the market would be up 15% in 2020. It frankly surprised us all a little bit on how aggressively we came back. But you can see we've had a really strong rally up until, basically now that April was kind of the bottom. It was a very difficult bottom. It hurt. But since then, because of our condition to look forward, we're on an improving condition cycle. So that's why the markets have been reacting positively, is that things are getting better. And the expectation is that they're going to get better going forward. So that just kind of gives you a little baseline of where we've been over the past couple of years. Because if you feel like it's been a little bit of a bumpy ride, you're not alone. It has been. So next slide, please. Perfect. Thank you. And so how I tail this in is, yes, this has absolutely been a difficult time, to stay within your plan to a certain extent, especially in, February and March of last year. That was extremely difficult. There's no question about it. And those things will happen in the markets from time to time. You're going to difficult events from the market. And that's how over time you actually, because you're taking that level of risk, that's how you achieve that. Unlike the casino mentality or those kinds of things, if you stay in the markets, the odds are generally in your favor. And we really like this chart. It's the odds being positive, is that if you look at it, the markets on a year-to-year basis, over 70% of the time are positive. We do have some really bad times, 1931, 2008, 1937 on the left-hand side that had 30 plus percentage declines. That hurts no matter who you are. But if you look on the right side of this chart, at least the right to me, I apologize if it's the other way to you, but you have much more significant, you have 20 years of 30 plus increases during those periods. So again, staying invested, staying within your plan that is designed up front that fits your needs, and staying with that through the bad and the good times generally is how you survive and you achieve your objectives in the markets. And so I think this really brings that home. Next slide, please. And the other one we're getting a lot of questions on, so I thought I would address it up front, is what about the new administration? What is going to happen? What happens when politics, infuse with what's happening in the markets? And I would say a couple of things. Is one, politics are always infusing in the markets, but the markets are extraordinarily adaptable. They adapt to changing conditions because, frankly, just think about it. Markets, businesses, right? And if your business doesn't adapt to what the current market environment is and is able to adjust, guess what? Somebody else is going to come in and do that job for you. And so we think of that as just general course of business. Sure, it has changes. There'll be some adjustments as a result of this. But this chart is one of our favorite charts, and it goes back to 1928. And the blue line is the S&P 500. And the bars on there are blue and red for different political environments. And you can see the one consistency over time is that the market tends to figure it out. And so whether you were yay Biden or nay Biden on this transition, chances are the market is going to be able to adjust over an extended period of time. There will be some chops and fits and starts and things that frustrate and benefit the economy overall. But over time, the market tends to adapt and still perseveres through any changes that come from politics and portfolios. And so we don't use politics as a real driver of what we're trying to do here. We think investment plans tend to outlive political actions. Markets tend to have longer economic cycles than just the presidential cycles. They don't tend to correlate. And again, going back to the businesses being adaptable, that's the kinds of things we're looking for. So again, I know that some people want to have that as a focus of theirs. And really, we say, yes, we monitor and pay attention to what is happening out there, but it's really not going to be a significant driver of what we're trying to do for your money. So with that said, that is my really quick 5-minute spiel about where we are and what we're looking at. I'll say quickly, the things that we're looking at for the remainder of the year. I think the biggest one is obviously COVID and recovery. There's no question that that's still the biggest influence on our economy right now, and probably for the remainder of the year, is how quickly do we get back to doing the things we want to be doing, whether that's vacations and seeing family and those kinds of things. How quickly can we start to do that based upon vaccine distribution now, because supply is becoming less and less of an issue. So now it's the logistics around distribution. And what does that mean for what can states do? What can people do with regard to getting back to their normal lives? Because if they do, I think there's a lot of pent-up demand for doing things and creating activities. And I think that's where you may see an accelerant of overall economic growth in the second half. Now, we're pricing a little bit of that in with the stock market strength we've seen thus far, but I still think that I think the future is looking more rosy than negative going forward. There's some things that could trip that up, but right now it's looking better, and that's why you're seeing the markets reacting so positively as of late.
Okay. And folks, just to let you know too, if you have any specific questions that you'd like Jeremy to address, you can use the chat feature here, and we'll try and get through as many as possible. I know one of the more common questions that we get nowadays, Jeremy, from clients is, should we have gold? I mean, is gold the best thing to be in during more volatile times?
Sure. It's a great question. I always tend to look at gold as a small component of your portfolio, but one that you can certainly have. The thing with gold is that it tends to be a store of value in times of runaway inflation, or when we're just nervous about everything else, right? We're nervous about the economy. We're nervous about government issues and those kinds of things. Investors tend to flock to gold during those periods. And you can saw last year, gold was very strong as a result of that because of those concerns. We're starting to alleviate, the general market is starting to alleviate some of those concerns and saying things are getting closer to normal than they were before. And you've seen this year gold have a retrenchment. So what I think from a gold perspective is, as a small component of your portfolio to kind of hedge yourself for bad times, is not the worst thing. But we never want gold, because it doesn't give any dividends or doesn't throw off any income and tends to be pretty volatile in and of itself. The volatility of gold tends to be pretty similar to what the volatility of the stock market is. So we want to be careful about having too much in there, but as a small component, 5 to 10% of your portfolio to hedge for those bad times, certainly no problem with that at all.
So speaking of inflation and interest rates, could you kind of talk about a little bit what your guys' overall outlook is? Are we going to see some increased inflation in the upcoming year, or possibly moving forward? And where do you guys kind of see interest rates at as well?
Yeah. So we've had a call for better part of since December that bonds are unattractive right now. It doesn't mean you can't own bonds, because they tend to provide a little bit of ballast for your stock portfolios. They're not just going to bounce around as much. A bad year in the bond market is -5%. A bad year in the stock market is -45, -50%, right? So we still advocate for having a component of bonds, but don't expect a lot of return from that. And the reason we say that is we think interest rates are going higher. And we're seeing that already. The interest rate started the year was 0.93% on the 10-year. Now it's over 1.5% or close to 1.5%. So you're already starting to see that. And what happens when interest rates rise? Existing bond prices fall. It's mathematical, because you can get more income from new bonds. You're not going to buy the old bonds, that kind of stuff. So we said, hey, we think they're going to be on the rise. We think economic recovery is going to be a focus. And especially in the second half of the year, we think we could see a pretty accelerated economy as a result of people doing things that they weren't doing before. So in that case, we think interest rates are going to rise in that regard. Is that, long-term rates especially tend to be much more driven by economic growth and sentiment there, whereas short-term rates are driven mostly by the Fed. And so the Fed can control that, and they'll keep it low. They've basically said they're going to keep those low. But long-term rates driven much more by what people think of the economy. And if we're right that the economy is going to grow, we think interest rates are going to rise. We think inflation will rise as well. There's no question that if we start spending aggressively, prices go up. It just kind of tends to be the function of society. The question is how far, how fast, and that's something we're going to monitor. We don't really have a stance on, are we going to see runaway inflation in the next 1 to 2 years? I honestly don't think so. In certain pockets of the market, sure, but in other areas, I think we'll be okay. The nice thing about that, to a certain extent, is that the Fed, in my opinion, is much better at controlling high inflation than they are about flattening prices and trying to stimulate demand, right? They can't tell me to go out and spend money, but they can rise interest rates really fast to put a curb on my spending of that money. So they have a little bit more capability to control that, but they've said they're going to let it run a little hot for a while. Now, inflation, like I said, we're at 2% level. That tends to be the healthy area. If it gets to 3, 4, and 5, especially if it gets to 4 and 5%, we're there. That's probably where they'll spur them to action in addressing some of the things to do to control that and not let it get out of hand.
Okay. Well, with diversification being key right now, one of the other topics and specific questions we did receive from a client was talking about the ESG ratio. What impact is that having on your investment decisions now, or do you what do you see it as a guide later on? Can you explain that for our clients?
And maybe just take a quick minute, Jeremy, for those that aren't familiar with what ESG investing are and what ESG means, kind of what that is, outline that as well. Thank you.
Perfect. Yeah, absolutely. So ESG is what it stands for is environmental, social, and corporate governance. And really what it is an investment strategy that tries to promote those issues, whether that's pro-environmental via renewable energy and those kinds of things, social, whether that's equal rights, focus on women, those kinds of things. And then corporate governance, are there strategies that are promoting equality and those kinds of things? So it's an investment strategy that tries to promote certain companies. It used to be much more just restrictive, right? We don't want to own tobacco companies and people that are actively harming the environment. Now it's gone to a focus of, okay, we still are restricting certain components, but now also we want to promote some of the people and the companies that we feel are doing the right things. And so that's where the ESG ratios and how a company performs on an ESG basis comes up. What I will tell you is that we have a dedicated portfolio to ESG. It's called our socially responsible portfolio. And that's where we concentrate we use ETFs or exchange traded funds to get a sense of that broad market and use ESG related stocks and bonds within there. So we have a dedicated portfolio aligned to that. Outside of that, we are monitoring that, but we don't think that at this point there's a specific mandate or driver or focus in the general markets around of specific needs to address that. We still go back to business fundamentals at the end of the day. How are your earnings looking? How does the growth outlook look going forward? So it's much more business fundamentals on the economy, the company, and what we're paying for those companies. So that's still our primary focus, but we are seeing some components of within that structure about how does that relate to how people focus on your business? If people think you are not a good advocate for the environment or for social justice issues, there may be a business transition away. And so we have to pay attention to that in that regard, but there's no specific mandates or requirements to do so. In the socially responsible portfolio, there absolutely is, but in our other portfolios, it's much more a component of the overall process and how we select investments.
And speaking of valuations, if you could touch base on what's your opinion on our markets overvalued, especially when we're discussing P&E ratios on some of these companies? What's your kind of thoughts there?
Yeah, good question. So markets are expensive. There's no question right now. If you look at compared to historical averages, we are certainly elevated on the markets. The reason why I think we can still grind higher, and I don't, what we've seen since October, I don't think that pace continues, right? I don't think we're going to be at an accelerated growth area like we've seen over the last 6 months. I think it's much more going to be a slow grind with fits and starts, from this point forward. And the reason I say that is that, again, just what you said is that market valuations have gotten pretty expensive. Now, there was a justification for it because when interest rates are low, it doesn't, from your bonds, you're not getting any income, you're not driving anything from that particular point of view. You're getting 1% from a 10-year treasury. It's like, well, I can take that risk, or I will be pushed out to basically taking that risk in the stock market. A lot of the valuation will be predicated on what we talked about before, is how far interest rates go upward, because you'll start to see people having that a little bit more as a debate. Is like, well, do I just hold bonds if I can now get 2.5%, 3% from bonds where I was getting less than 1% before? If I can get that, maybe I'll shift some of my assets from the stock market, which is, again, has that ups and downs and higher volatility. I'll take some of that income from there and I'll move. And that could have a suppressive impact on the valuations and make it a little bit cheaper overall. But that's offset to a certain extent by what our thought process on the economy is that if we're in an accelerating economic pattern, like I think we're going to be in the second half of this year, it's really difficult to say the market's going to have a really bad time during that period. It just doesn't tend to correlate that we have really bad times when the economy is full steam ahead. So that's why I think it can grind higher. Would I expect another, 20%? It could happen. Could we see a 20% reduction? Absolutely. I mean, those corrections usually happen from things we don't see, right? Is that at this point last year, did we all think we were going to be at home sitting here and trying to figure out what we were doing with COVID? That's why the market reacted down 30%, right? Is that, oh, we didn't see this coming, and this level of magnitude of destruction that as a result of that has a significant impact. Based upon what we see right now, we're not in that mode. We're much more in growth mode, and valuations can stay elevated during that time, but it is something we're watching, especially if interest rates continue to rise aggressively. And I'm talking not 1.6, not 1.7. I'm talking 2% plus on the 10-year treasury before that even becomes a real focus of conversation.
Okay. Well, Jeremy, I appreciate your time this morning. I appreciate clients taking the time out of their morning to listen to what you have to say. If anyone has any follow-up questions for us or for Jeremy specifically, please don't hesitate to reach out to us at the office, or you can also go to mattsonfinancial.com and send in a quick request there, and we'll make sure that it gets its due attention.
Yeah. So any other questions, give us a shout here. The phone number is 616-514-3831. And we'll be glad to follow up with Jeremy if it's something that, we feel that we would like his input, or any of the other portfolio managers there at Gradient Investments as well. So thanks everybody for spending the time with us this morning. I hope you guys got some good information, saw some value here. Jeremy, thanks for being with us. I know it's a little earlier over there in Minnesota this morning. So
hey, not a problem.
All right.
Thanks for having me, guys. I appreciate it.
Yep. Thank you.
Yep. Take care.